We are super excited to have you guys with us. We know your time is super valuable. So we're going to keep this very quick and punchy. We're going to go through a lot of stuff. 15-second intro to me. I've been in real estate since 2003. I started out working for a hard money lender. I spent the last 10 years living abroad and investing passively in real estate for a lot of that time. I wanted to keep investing in real estate. I wasn't living here in the US anymore. So passive real estate investing is really how I did it. Deni and I, we've known each other since 2008. Deni's been in real estate even longer than I have. She's got 40 years experience in real estate. But yeah, so our pledge to you guys is in the next 20 minutes, we want to cover how we personally invest our own money in real estate when every asset in the world looks like it's in a bubble. The S&P 500 here over the last 3 years, it's had pretty frothy returns, right? 3 years running. These very high returns, at least by historical standards. Historical returns for the S&P 500, it's around 10%, 10.5%, going back to 1926, before there were 500 companies. These have been outlandishly high returns in the S&P 500. The NASDAQ 100, each one of these years, for the last 3 years, over 20% returns. This kind of tech-heavy AI bubble potentially that we're looking at. And speaking of tech or AI bubbles, Nvidia, which is a poster child for a potential AI bubble, it's up 721% over the last 3 years. These are just outlandish numbers. Gold up 72 or 73% over the last year, which is a little worrying because gold is a safe haven asset, right? It's where people flee when they think that other assets are looking too frothy, right? Silver up 163% over the last 12 months. Home prices are also hovering around record highs. This is from Zillow, as you can see. This is around the record high for home prices. It's been hovering around here for the last year or so. So this begs the question, are there any assets that don't look frothy, that don't look bubblicious here? The case that we will make is that multifamily is not in a bubble currently because it was in a bubble in the very recent past. I mean, there was a bubble in multifamily, and we'll show that in just a second. This graph is not perfect, but you can see this is the index here, the multifamily index. In late 2021 or 2022, it hit a peak and then dropped down and then has started rising again since then. Here, this shows it even more starkly. So this is another multifamily index from the Federal Reserve. You can see 2008 right here, and then it crashes down. And then this is 2022 when it hits this peak and then crashes back down, right? And one of the panelists on the economics panel earlier was talking about how multifamily real estate dropped 25, 30%. I think he actually said 25 to 40%. But depending on which measurement you look at, it was around a 25 to 30% drop in value, which is, by the way, how much residential home prices fell after 2008 when everyone was freaking out about it. Now, not that a lot of people didn't even talk about this because so few people have an ownership interest in multifamily. But back in 2008 and the housing crisis and the Great Recession, a 25 to 30% crash in home prices, people were running in the streets, pulling on their hair and saying that the sky was falling, right? So this was a huge crash in value. Now, we're going to talk about how the trend line here. So the trend line, obviously, it departs the trend line. And this is the trend line since 2015, but it goes back even further than that, of course. Departs the trend line to go up into a bubble, crashes back down. Now, it's still below that trend line. And by the way, even this number from the last 10 years is still lower. Ending up here, this is still below the average trend line over the last 40 years. So if you look at this 30-year stretch, the average annual increase was over 5%. And because of this crash, the last 10-year trend line, or the last 10-year average is actually lower than what the historical 40-year average is. So none of that is to say that there's no risk in multifamily. There certainly is, and we're about to dive deeper into that risk. But there is a case to be made that multifamily was absolutely in a bubble, and then that bubble burst already, ahead of some of the other asset bubbles that people are worrying about, like stocks, like AI tech companies, gold and silver and home prices. And here you can see that there are some tailwinds here for multifamily where supply hit this huge peak right here of record new supply of multifamily units hitting the market. And then that is also crashing back down. So with much less new supply hitting the market over the next few years, that is going to allow demand to catch up with supply here. Okay, so looking ahead, three main risks that we see in multifamily and other real estate that we just want to highlight and talk through some of the ups and downs of all this. So risk number one here, recession. This brings higher rent defaults, right? We have more unemployment, people are losing their jobs, they're tightening their belts, they tend to default on their rents more. You also have higher vacancy rates, right? It goes hand in hand with the higher rent default, right? And household bundling effect, where people who in good economies might live independently from each other. In bad economies, they move in with one another. So, right, like roommates who ordinarily maybe they would rather have two one-bedroom apartments. Now they move in together into a two-bedroom apartment. Or adult children in their 20s or even 30s moving back in with their parents, right? You see that kind of stuff happening in a recession, which of course boosts the vacancy rates here. And this all translates to just lower net operating income for a lot of multifamily properties. Now, this is a double-edged sword. There's a flip side here. Recessions also bring lower interest rates, and cap rates move almost in lockstep with interest rates. So the silver lining here, or the other side of this sword of recession risk, is that it does cause the Federal Reserve to slash interest rates to the bare bone, which is great for borrowing, great for cap rates, and helps pull real estate out of the weeds, as it were. And you actually see this in recessions where real estate is or multifamily is one of the first things to recover in a recession. Now, that being said, Deni and I, when we look at multifamily deals, we want to see some kind of recession resilience built into the deal. So this is one example. We've invested in a handful of deals where the operator has gone out and they've partnered with the local municipality or county to set aside a certain percentage of the units as affordable housing. And in exchange for that, they get a property tax abatement. So they don't have to pay the full property taxes. In some cases, don't have to pay any property taxes on the property, which lifts up the NOI from day one. It's an instant way of boosting NOI without having to swing a single hammer, like the typical value add, you go in and you renovate units. But when you negotiate this kind of deal, you bump up the NOI instantly by cutting out the property taxes or drastically lowering the property taxes.
And no hassle of a Section 8.
Yeah. And the other thing that we see here for recession resilience is that these rent-protected units, these are heavily coveted even in normal economies. In a recession where everybody's hypersensitive about spending on rent, these become even more coveted among renters. So you see a wait list for these. Class B multifamily can have some buffer in a recession. Now, I think some operators can overstate this point, so I want to be careful not to overstate this. But there is some truth to this argument. And the argument goes, in a good economy, Class C renters move up to Class B, right? And Class B renters move up to Class A properties. And in a recession, Class A renters downgrade to Class B. So in a recession, there is always going to be demand for that housing. And if anything, the class of renter actually improves because those Class A renters, what were formerly Class A renters, they're moving down to Class B. Again, that point can be overstated, but there is some truth there. Undersupply. So in the local market, and obviously all real estate is local, and we talked about this a little bit in the economics panel, or the panelists spoke about this, how this is all local, right? It's hyper local. So when you're vetting multifamily deals or any real estate deal, you need to vet it at the local level. What's the population growth? What's the local unemployment rate? What's the local wage growth? What's the local vacancy rate? What are the recent rent trends in that market? Now, excuse me, I'll give you a quick example of what we're talking about here. We invested just a few months ago, and actually, I think it was with Lee Yoder with Threefold REI, who's going to be speaking tomorrow. This was a property in a tertiary market in Ohio where there hadn't been any new construction of multifamily at all since before the pandemic. Now, there's not a whole lot of population growth in this market either, right? It's a slow growth market, but there's no new supply coming online at all there, and no permits for multifamily new construction either, like looking into the future, because there's obviously a long pipeline for that stuff. This was a deal that this provided some recession resilience, right? There's no new supply. There hasn't been new supply for a while. There's no new supply coming because it's a small city in Ohio. And then there are niche strategies out there. This is another way you can have some kind of recession resilience in multifamily investments. So one quick example of this is the Section 8 overhang strategy. And this is one of those like deep niche things that most people have never heard of. The short version is that an operator will go in and they'll buy a LIHTC property, a low-income housing tax credit property, which comes with all kinds of tax advantages, right? And that helps with the cash flow and the NOI. And what they will do is they will gradually cycle out the cash tenants, the market tenants, and they will cycle in Section 8 tenants. And the reason that makes sense and why they can make so much money doing this is that the LIHTC tax credit, the restriction there is about the amount of cash rent that the tenant is paying. It's not about the total amount of rental income that the operator is collecting. So in Section 8 pays the majority of the rent, right? So the tenant is only coming out of their own pocket with cash for a minority of that rent payment. So in doing so, they're getting a deep discount when they buy the property because the NOI is artificially low because of the LIHTC restrictions, right? And then they can get the full benefit of the full market rents by cycling in Section 8 tenants and keep the tax benefits of the LIHTC. So anyway, there's just a few examples of some of the recession resilience that we look for in multifamily. And to tie that back to recession, Section 8 is paying most of the rent, right? And Section 8 tenants, so they're not defaulting on their rents at the same rate that cash tenants are defaulting on their rents. And they don't want to lose their Section 8 vouchers. So it's very important to them to keep those rents current. All right. Other asset types can also help provide some recession resilience. I don't want to emphasize too much multifamily here. Self-storage. When people downsize, what do? They put their stuff in storage.
Or when they combine households, more storage.
Or when they combine households, exactly. Yeah. And if you go back to 2008, the only real estate asset class that saw a growth or positive returns was self-storage. This can be a recession-resilient investment. Again, it's hyper-local, right? You got to make sure there's not an oversupply in that micro market. But that can be a recession-resilient real estate investment. Industrial. We have invested in an industrial property where the sole tenant is a company with over 3 years of order backlogs. And their largest client, by the way, is the US Navy. They're not going anywhere, even if a recession hits, right? They have such a deep backlog of business and such reliable clients that they're going to be okay. And then we just spent a whole bunch of time talking about land. This too, and especially Brent's strategy that we have invested with him on, by the way, our co-investing club has partnered with him on some of these deals where he buys a piece of land, installs a manufactured home, and then sells it to a first-time home buyer. And those homes go for half the area median home price. So even in a recession, there's always going to be demand for half-price homes, right? So anyway, that's risk one, recession. Risk two, inflation. So the risk here, it does lift the operating costs, right? Higher labor costs, higher material costs, higher insurance premiums. And we've seen that over the last 3 or 4 years, right? That's been a big challenge for real estate operators. Inflation also forces the Federal Reserve to hike up interest rates. And we already talked about how cap rates move in lockstep typically with interest rates. So higher cap rates mean lower property values. These are all risks to real estate investments. All right, so what's the double-edged sword here? Inflation also brings higher rents. Rents are not only do rents move in tandem with inflation, rents are the primary driving force of inflation. Yeah, if you look at how the Labor Department breaks down how they calculate inflation, rent makes up the greatest proportion of that. All right, risk three, the third risk we're going to cover today is geopolitical risk. So this comes in several forms. Changing regulations, either at the federal level, the state level, the local level, that is a risk, right? Especially for multifamily, for residential tenancies. Trade
Brian,
wars.
can I interrupt you real quick? I'm sorry, there's a question about the past And it's really good. So I just want to.
Okay.
Okay. Although there are potential Section 8 conversion benefits, is there a risk that non-Section 8 units in the area become unattractive, potentially offsetting the benefits?
Is there a risk that non-Section 8 units become unattractive?
So in that community.
Okay. So you're saying like if the quality of the tenant goes down because, okay, I see. So these, and I would argue no, because these units were already renting for way below market rents. So it's already serving an affordable housing niche in that local market. Section 8 renters are, just to make up numbers, let's say that cash tenants are paying this artificially low rent of $1,000. And then you can bring in Section 8 tenants who are paying $1,500. But you're pulling from the same pool of affordable housing renters, right? Does that make sense?
Yes.
Okay. So yeah, political risks and geopolitical risks, changing regulations. Yeah, and obviously over the last year in particular, we've seen a much faster pace of regulation change, at least out of the federal government, which adds risk to any kind of investment, right? Trade wars also add risk, inflation risk, it can add recession risk, right? And then armed wars, these are all geopolitical risks. But the good news here is that housing is pretty protected from armed war risk in the United States, at least, because it's so geographically isolated. When was the last time we had a land war within the US? It was the Civil War, right? But these are risks and they are something that you have to take into consideration. But here's the thing is that there's always something to be scared of in any asset class at any point in history. To illustrate that point, hopefully you guys can see this pretty well. This is just going to show all of these big risks or crises over the last 100 plus years. Here's the coronavirus crash, and here's the 2008 recession and subprime mortgage crisis, and here's the dot-com bubble, and here's the September 11th terrorist attacks, and here's Black Monday in the late 80s, and the Berlin Wall falls, and Kennedy assassination, and Cuban Missile Crisis. There's always something, right? There is always going to be something that is scary and that is going to spook investors. And this is why people say, go buy when there's blood in the streets, right? Go buy when everybody else is scared. Now, we don't try to time the market. We're going to talk about that in a second. We actively encourage people not to time the market. But the point is just, don't let fear of whatever the boogeyman du jour is affect your real estate or your strategies, right? Have a core investing thesis and stick with that over time. Now, as far as timing goes, this was just released a couple weeks ago. This was from the UBS Billionaire Survey. So this is how billionaires are moving their money in 2026. And the top one here is private equity. Not all of that is real estate private equity, of course, some of it's companies, but private equity real estate syndications and private equity real estate funds, that falls here, right? And then this is private equity funds. Real estate syndications falls here at the very top of where billionaires are increasing their exposure. Private equity funds, private debt and debt funds. That could be private notes, which is something that we look at quite a bit in the co-investing club. It's also what Chris Seveny, he was just on the economics panel talking about his debt fund. And then here's directly owned real estate as well. So our co-investing club anyways, all passive real estate, but we do partner with active investors on these deals, right? So we direct partner with them as joint ventures. So question is, how are we personally investing our own money? First of all, we don't time the market, right? We practice dollar cost averaging. Every month, sometimes twice a month, I'm putting money into a new passive real estate deal. And the way that I can afford to do that is that I'm only putting $5,000 or so at a time in each one. So that lets me spread smaller amounts of money across lots of different deals in different geographical markets, across different asset types, with different operators, across different investment timelines. So on the geographical side, like this is a map of everywhere that our co-investing club has invested. Like every passive real estate deal that we've ever invested in is on this map, right? And it's all over the place, right? And that's part of what we're going for. And here's a quick illustration of this. let's say you have $60,000 to invest in a given year in real estate. That could get you one rental property, right? Between the down payment, closing costs, initial repairs, et cetera. Or it could get you into one syndication. Or if you're investing $5,000 at a time, that's 12 different properties or syndications. Again, a chance to practice dollar cost averaging so that you're not tempted to time the market. So you have a lot of different like small income streams and small investments rather than the typical just a couple, because you had to put 50 to 100 grand in each one. And the whole purpose of this is that your returns across all of these different investments, they start to form a bell curve where bottom left-hand corner of this curve, you've got investments that are underperforming, right? And then over here on the right-hand side of the curve, these are investments that are overperforming. And most of them are just going to land somewhere in the middle of that bell curve. But when you invest in enough real estate investments, they start to form this bell curve instead of having the one off or two off. They could be down here, right? And keeping you awake at night because that one investment that you made is such a large percentage of your net worth. So
See all eggs in a basket too. Now,
exactly.
one egg breaks, it's not breaking the whole basket.
Yeah, exactly. I put about half of my investments into stocks, and I put the other half in passive real estate investments, typically with 5 to 25 grand a piece, relatively small amounts across a lot of different deals. Now, what does that look like as far as asset types? Some of it is debt, of course. We talked about that. Private notes, typically secured by real property. Equity investments could be multifamily, it could be land, storage, industrial, mobile home parks, single family rentals. We've done all that stuff in the co-investing club. And we continue to do all that stuff month in and month out. Diversifying across timelines. This is important too. The shortest investment we ever made was a rolling 6-month note where people can pull their money out with 6 months notice at any time. The longest investment we've ever made in the co-investing club was indefinite, where the idea is that infinite returns model where the operator is going to refinance and pull the money back out of the deal and return your money to you so you can reinvest it, but you keep your ownership interest in that property and keep collecting cash flow. And the idea behind diversifying timelines here is to stagger your returns of capital so that it forms a ladder, right? Every year that goes by, like some of your money is coming back, but you're not getting these huge lump payouts all at once, which is going to ruin your tax bill, right? So just staggering that return of capital. Deni, how are we doing on time? Do we have time to get into the lazy 1031 exchange, or are we running out of time?
You might want to speed it up a bit.
All right, we'll skip the lazy 1031 exchange. Short version is if you just reinvest capital in the same year, then it can offset your taxes. All right, so our goal here is not trying to predict the next hot asset class or the next hot city or market. Our goal is to invest with the law of averages on our side, right? We want the law of averages to be looking out for us rather than trying to time the market. Here's a sneak preview, and then we'll wrap up for questions. This is the deal that we're going to be meeting to invest next week, or meeting to vet next week. This is with an operator who we've invested with several times before. They're called Freeland Ventures. But this is a multifamily deal in Ohio. And these are the return structure if we invest at least 300 grand, which our co-investing club probably will collectively, even though each person can invest with 5 grand or more, or 2,500 if they're a VIP member. But because we are investing under a single LLC that invests as one limited partner in the deal, we get the preferential returns oftentimes. So this is forecasting an 11.31% cash on cash return, 8% distribution yields for the first few years, and whereas a 22.31% forecast annualized ROI at the time of refinance in 3.5 years. Again, this is a property or an operator who we've invested with before, but this is the kind of stuff that we look at together in the co-investing club. We meet every month. We vet these deals together.
Twice.
Sometimes twice. Yeah, often twice a month. So we bring the operator in, we all grill them together with questions, and then we boot them off the call. And we have an internal club discussion about the deal and about what risks we see in that deal. What do we like about it? What are our concerns? What do we not like about it? And then anyone who wants to invest in that deal can do so. No one has to. So,
and it's really cool because we have people from all walks of life who will ask questions that sometimes will make me stop in my tracks and be like, "Oh, that's good." So
Yeah, that's our approach to real estate investing, to spreading risk across time, across markets, across operators, across asset types. So, Denny, do we have time for a couple questions?
Yeah, we have one so far. Anybody, just throw your questions in the chat. More asks, how about the AI risk as far as double-edged sword in general at a macro level and in specific like data center investments?
Yeah, the big risk with an AI bubble is that it causes a huge meltdown in the stock market and a broader meltdown in the economy. But the stock market crashing is only really a risk to real estate investors to the extent that it contributes to causing a recession. Now, and we did talk about recession risk already, how that does pose a risk to real estate investors, higher rent defaults and higher vacancy rates, et cetera. Are we in an AI bubble? Maybe. I don't know. That risk is definitely there. As far as data centers go, I don't see that posing a huge risk to other types of real estate investments. We've never done a data center investment ourselves. Obviously, if you are investing in data center deals and it turns out that AI is in a bubble, then that creates direct risk for you. We've never invested in a data center. We're insulated from that particular risk. But like we said, there's always a chance that bleeds over into the broader economy.
And has the club lost money in the last few years, and what lessons have we learned?
Yeah, we've had a couple deals go south on us, right? There have been a couple deals that have been at that bottom left-hand corner of the bell chart, the bell curve. A couple lessons that we have learned. One of those lessons is to make sure that when you're vetting the operator, you're vetting the lead sponsor on that deal and not necessarily a co-sponsor of the deal. It sounds so obvious and intuitive in retrospect, but that was an early mistake that we made. The main sponsor for this one deal was somebody who had very little experience, but it was co-sponsored by this huge company that everybody knew their name and they had a great reputation at the time. They no longer do, but they had this great reputation and they were a huge name. And it turns out that they were actually co-sponsoring their student who they had educated and trained for a hefty price, of course. And so it looked like they were the main sponsor of the deal, but they actually weren't. And then there were a million other things that went wrong with that deal. Insurance went through the roof and they got a variable interest loan, which also went through the roof. There were a lot of things that went wrong with that particular deal. But yeah, there are real risks. But one of the nice things about being on potentially the other side of that bubble is that the worst players in the game have already been removed from the board. And the ones who have survived and thrived over the last few years of a difficult market are probably doing something right. Now, obviously, there's a lot of due diligence that we all need to go through when we're vetting a sponsor and vetting a deal. But yeah, so a couple of deals have gone south on us, but the overwhelming majority of the 44 plus deals we've done, most of them are doing well.
And again, with the lower investment amounts, because it allows you to spread it. If somebody does go under that or have problems, it isn't as devastating as if you put 150,000 in or something.
Right, because you've got small amounts just forming a bell curve, averaging out over time.
Sheldon asks, when investing through a business, are there income limitations? And is this accredited versus non-accredited?
Yeah, so this is something that we're really proud of in the Co-Investing Club is inclusivity and serving non-accredited investors as well, because accredited investors have a lot more options available to them. And sponsors can advertise to them, right? It's a lot harder for non-accredited investors to find deals and have that deal flow. So we really go out of our way to look for deals that allow non-accredited investors as well and have that be a part of the deal flow so that there are investments every month for our non-accredited members as well. As far as income limits, no, there are no income limits in the co-investment.
And yes, you can invest as a business. We have several people that do that.
Or under a self-directed IRA, for that matter.
And I guess that is it. No more questions.
All right. I'm going to stop my screen share. Thank you guys for your time and for your questions.
Absolutely. And I hope everybody is enjoying the summit and learning and the whole 9 yards.